Good morning.
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 Good morning.
Hi.
Whoops, that's the wrong picture.
Yeah.
Oh, it's doing a slideshow of all my pictures. Isn't that fun? There we go.
Good morning, everyone.
Morning.
Good morning.
Hello.
Morning. I love Chris's icon.
Don't miss Rich's State Fair Savings Extravaganza.
Had to make it interesting.
Now I want to get creative.
Morning.
And usually it's just singles.
Oh, there's different versions, so different denominations.
I know if you got a big money clip, you got to have, like 50s and 20s in there, but usually it's just singles.
Looks like we almost have everybody.
Dave Hughes isn't going to make it today.
Right, okay. Yeah, I was just looking to see if Scott was on.
So does Chris Cullinan's icon there, does that mean he hit the lottery or something and he's not going to join us?
No, it just lets my family know how much cash I've got on me. So when they hit me up, they know what to ask for.
Well, that's good. I don't bother having a money clip because my kid takes all my cash.
All right, why don't we go ahead and get started? I guess I'll call this meeting to order of the Retirement Commission. The first thing we're going to do, John Blair has joined us, so we're going to actually go into closed session. It's the first item on the agenda. And Heather, would you be willing to make that motion to go into closed session?
Yeah, I have it here. Pursuant to section 2.2, 3712 of the Virginia Code, I hereby move that the Charlottesville Retirement Commission close this open meeting and convene in a closed session as authorized by Virginia Code section 223711A8 for the consultation with legal counsel about specific legal matters related to the Virginia Conflict of Interest Act. I'll need a second.
Second.
And then I
All in
think we
favor? We vote.
Aye.
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 Hi.
Any opposed to that motion? All right. I sent out the conference line last week, and I actually just sent out the passcode. I think I forgot to put that in the email. So there's another email that you should have just gotten a few moments ago with the passcode in case you need that. So if you want to log out of this Zoom meeting, give me just a minute to set up the conference line. Oh, there's Scott. Hey, Scott, we're just about to go into closed session.
And we will leave the webinar running, Jason, so you can come back to this.
I would just, anyone, yeah, everyone should leave the webinar that it's not Brian, I guess, or that's on the commission.
And I'm going to put up a placeholder slide that just says you're in a closed meeting.
Okay. All right. So you should have that email with the conference code info. All right, looks like everybody's back, just about. Okay. Heather, would you like to read the motion again?
Sure. I move that the Retirement Commission certify by recorded vote that to the best of each commissioner's knowledge, only public business matters lawfully exempted from the open meeting requirements of the Virginia Freedom of Information Act identified in the motion convened in closed session were heard, discussed, or considered in the closed session. And I'll need a
Great.
second.
And I think we'll do a roll call. I have a second.
Is there a second?
Second.
All right, Chris. Okay, I guess I'll go through the roll here so we can record that vote. Al? Scott?
Yay.
Heather?
Yes.
Markel?
Yes.
Joe?
Yes.
Michelle?
Aye.
Dr. Richardson?
Aye.
And Chris?
Yes.
And Jason? Yes. All right, great. Okay. All right, I think the next item on the agenda is the approval of the August meeting minutes. They were sent out on Friday. Did anyone have any questions or amendments to the minutes? Not a, is there a motion to approve the minutes?
So moved.
Second.
All right, all in favor of approving the minutes?
Aye.
Aye.
Great. Okay. Now, I'd like to welcome Greg McNeely to the meeting. Thanks for joining us. Greg is our advisor from Dayhab Associates, and typically in September, Greg comes to our meeting to give a review of the previous fiscal year. But primarily, we've asked Greg to join us just to give us a little more perspective on our current portfolio in regards to the work that we've been doing on sustainable investing and ESG. And so he's going to be sharing some information with us and answering any questions that you might have to move us a little further on about making a decision. So with that, I will welcome Greg.
Good morning, everyone.
Hey, Greg.
Good morning.
Jason, I think first off, if I can go quickly through the last fiscal year's performance just to kind of highlight. I'm sure you forwarded them my files from last night? Have they gotten those?
They've gotten the annual financial report that came out for the June 30.
The thick one.
The big one. Yeah, I think that's what they have. Yep.
All right. Well, this is just if I could, I'm going to share my screen.
Yeah, Brian, he might need permission to share.
It looks like I can. Can everyone see that?
Yes.
All right. Well, this is my, and again, Jason has this if you guys need it. This is my kind of summary of that 200-page report that you get, so you don't have to look at it all. I do color code it, so green is good, red is bad, or red is, green is outperformance, red is underperformance. So you can see there's not a lot of underperformance when you look at the portfolio. I think the number you're really looking at here for your fiscal year is 3.4%, 2.9% net. It was not a good year. Of course, the quarter that that was negative was that March quarter. We did make up a lot of ground during the June quarter, but that March quarter kind of set us back behind that actuarial assumption. So for the quarter, again, for the fiscal year, 3.4%, 2.9% net. That puts you in the 48th percentile of our public fund universe. Really, the weakness you could see in any annual performance was in bonds. In bonds, you had to be higher quality, and you actually had to have a lot longer duration. So 30-year treasuries was the best place to sit your money over the last 12 months, through June. And this is an active portfolio. It's got corporate exposure, and they had sat their portfolio a little bit shorter than the duration, a little bit shorter than the benchmark. So falling interest rates did not do it any justice, did not do it any good for the year. And where you see the underperformance, 7.6 for the fixed income and 8.7 for the aggregate bond index. You can see some of the influence of treasuries. The Bloomberg Gov Credit, which strips out mortgages, was up 10% over the last 12 months. So there's the underperforming. Really, any underperformance anywhere where you suffered was really in the bond portfolio. Elsewhere through the portfolio, large cap has done pretty well, 6.5% for the fiscal year. Underperformed the Russell 1000 slightly at 7.5%. We had outperformance from Cornerstone, your large cap value manager. We had underperformance from Wells and your index fund, your enhanced index fund. Longer term results are still pretty strong. If you look at the last 3 years, 10.5% versus, 12.5 versus 10.6. And the last 5 years, 11.2 versus 10.5. Mid cap, we did we have two pieces of mid cap portfolio. One thing to note as you go down through the market cap ranges, large cap was the place to be, specifically large cap and technology. That's one of the reasons why Cornerstone did pretty well. They were underweight energy, overweight technology. They had exposure to both Apple and Google or Alphabet. But as you go down through market cap ranges, you can see the performance as you get smaller in market cap, the worse your performance got. Mid cap was only up 0.2%. And small cap was actually down 110 basis points. So the smaller you got in market cap, the worse your performance was. We are, of course, diversified, so we have exposure to mid cap and small cap. The good news there is that your managers did a much better job within those asset classes. So mid cap, again, this is made up of two different pieces. It's made up of Davenport, and it's made up of a passive piece. So the passive piece is managed by SSGA. And it's a complete replication of the S&P 400. Your mid-cap portfolio was up 20 basis points. The index was down 2.3%. So Davenport did a good job on the upside or on the downside, holding some of that return. Longer term, and again, this is mostly due to Davenport. You see longer term performance has been pretty good in the mid-cap side, 8.4 versus 5.8 over 3 years. And 7% versus 6.7 over 5 years. Davenport has not been here that whole 5-year time period. So if you've been here a while for more than one meeting or two meetings, you can see that this is a number that was red not too long ago, and Davenport's kind of pulled it up into the green. Small cap, again, made up of two different pieces. Our biggest piece is our active small cap value piece with Atlanta Capital. Atlanta Capital has a big influence on that. The small cap growth piece is about a quarter of what the Atlanta Capital exposure is, and it is passive. We couldn't find a manager over the years that outperformed on a consistent basis, so we went passive with it. And again, it's a complete replication of the Russell 2000 Growth Index. Small cap, as I mentioned, your portfolio is down 1.1% for the year versus the Russell 2000 index is down 6.7. So again, there's some of that, saving the return on the downside. You'll hear me talk about downside capture ratio and upside capture ratio. This is one thing we pay attention to. We try not to capture all the downside. And again, with the only active piece in here being Atlantic Capital, it's really on Atlantic Capital's shoulders to do that. Longer term, again, Atlantic Capital is the main contributor to this, but long term, 8.4% versus 2% for 3 years, and over 5 years, 8.6% versus 4.3%. Skipping to the international side, international has two different pieces. One is your developed market, one is your emerging markets. We do have passive pieces of both of these portfolios. Together, they make up your total international international return. One of the things we have done over the last number of years is we have underweighted international. Our target to international is 15%. We've actually tactically kept it underweighted just because we haven't seen the growth perspectives on the international side, and that continues to be an issue. So you can see last year the developed market international was the worst performing piece of the portfolio, down 4.3%. And of course, we're looking at it versus the benchmark. The MSCI EAFE index was down 5.1. So in a tough market, your managers have done a pretty good job. And again, to say they outperformed over the last 3 years, the international markets measured by the MSCI EAFE have only returned 0.8% on an annualized basis, and that's why we have been underweight that asset class. So that has been a good decision to make over the last number of years. In 5 years, 2.2 versus 2.1. Emerging markets, and let's highlight emerging market for a second because we will talk about this in a few. This is the place where you will run into a lot of your energy exposure. There are a lot of small, quote unquote, energy companies around the world, and a lot of them stick here in the emerging markets index. It's a small piece of your portfolio. It's a 5% target weighting. We are underweight that at the moment, but emerging markets last year 1.7%. Again, international has not been a place to be. The emerging markets index was actually down 3.4%. So your manager, in this case, Axiom, has done a good job on the emerging market side. 3-year turn, again, Axiom is your active manager. They're the one that's going to add the alpha to the portfolio, 4.2 versus negative 1.9%. And the 5-year return is 4.1% versus 2.9%. So then, good performance there. We talked a little bit about fixed income performance. Long term, it's fine. Shorter term, because of the underweight or not having the portfolio in long government portfolios or long government securities, has had some slight underperformance, and you see that push through the 3 and 5 year return. Long term, the returns are ahead of the benchmark. Our real asset portfolio, we can probably highlight this too, because in my coverage of your our ESG discussion that we will have, this is probably a place that it gets overlooked. To give you an example, our real assets are made up of real estate and right now agriculture. So real estate, you look at real estate and our exposure to real estate and building, and properties. Within the funds that we have the managers purchase, or when they buy buildings, they look for LEED certification, which I forget what LEED is, but it's a LEED building, or a LEED certified building is a green building. Whether they use, they put solar panels on the building, or they use certain kind of lighting, or whatever the case may be. So you have LEED certified buildings within your real estate portfolio. And then in your agriculture portfolio, if your manager buys a plot of farmland, not all of that farmland is usable. It's not farmable. So what they do is they take the non-farmable pieces and they add wind farms, or they add solar farms to it. So you actually do have some alternative energy investing within this real asset category.
Greg, in the LEED piece, which stands for Leadership in Energy and Environmental Design.
Thank you very much.
Run by the U.S. Green Building Council, and the city is a big supporter of that, and we design and build our buildings that way. Can we get information as to the percentage of buildings in the portfolio that might be LEED certified?
I can get that for you. Yeah, it's managed by J.P. Morgan, and I can get that for you.
I think that'd be a good piece of information to have.
Yep. And I can also get you details on just what you have in that agriculture portfolio. I think the last report they gave me, and it's not something we do on a continual basis, but the last time I checked with them, about 10% of your total farmland has been used for alternative types of energy. And again, that's just because they could have a hilly piece of the land they bought that they can't farm on, and they decide to put solar panels or wind farms on there.
Okay, good. So, Commission, I think this is information that can immediately be used to defend where we are and beginning to make progress with sustainable investing. Both of those pieces we're already doing it, and they're in the pocket.
I totally agree. Again, was it something we consciously went out and said, hey, look, let's get some green energy type of investments in here. That wasn't the case. It was totally looking at returns. Returns.
So it's a win-win.
Exactly. It was a win-win kind of looking back at it. There are some other things.
Yeah, just to back up Scott's point, I mean, we always talk about fiduciary duty, and again, looking at the agriculture snapshot in here, in addition to all the things that Scott mentioned, it also fits in with our fiduciary responsibilities.
Right. Just a review of who you have in this portfolio. There have been no changes since the last time we met back in September of 2019. Everything is the same. State Street Global Advisors, they are really our passive manager. Passive investments are a way to, number one, get complete market coverage, and number two, save fees. Passive management is cheaper than active management. But what you do is you give up the possibility of positive alpha, and again, the upside is your batting average is always 1,000. You're never going to lose to the benchmark. There are a couple pieces in here that are not totally passive. Number one, your large cap core is what they call an enhanced index. So what they do is they take the S&P 500 and they screen it for certain criteria, and you end up with a portfolio of about 300 stocks. So, and again, that's going to come into play when we talk about ESG investing and part of their screening process, and I'll get to that in a little bit. So again, not by, it wasn't a decision we made to say, hey, let's go out and get a greener portfolio. It just happened that they had an enhanced index, they had better returns at the time, and we went into it. But the flip side is we do have some. The manager is what they call a PRI signatory. Principles of Responsible Investing is a UN resolution, and they are a signatory, so that comes into their active management process. But we do have a lot of different pieces with them. With SSGA, we've got domestic equity, we've got mid cap, we've got small cap growth. We have an international value piece that is an active piece. It's a 2.5% target. We have a developed market passive piece, which is relatively new, and emerging markets passive piece, which is only 2.5% of the target of the portfolio. And again, that's to get our emerging markets exposure, get exposure to those markets, and we do it relatively cheaply. Your large cap value managers, Cornerstone Investment Partners, done a very good job on the large cap value side of things. Wells is your large cap growth manager, Wells Capital Management. They've done okay. They did have some underperformance over the last 12 months, basically because if you didn't have 5 stocks in your portfolio, Apple, Microsoft, Amazon, Google, and Netflix, if you didn't have those 5 companies in the percentage that the index had those 5 companies, you underperformed, and they did not have those 5 companies. Those 5 companies, by the way, now have a larger market cap than the entire country of Japan. or they did anyways as of June 30th. I'm not sure where they are at the moment, but they have come back down to earth a little bit. Davenport Capital Management, Davenport's out of Richmond, picked up the active mid-cap piece about 4 years ago now. Done a very good job. Atlanta Capital has been in this portfolio now for about 15 years. They've done an outstanding job in the small cap value side of things. Artisan Partners is your international growth manager. That's a mutual fund. Axiom is your emerging markets manager. That's a commingled fund managed by Axiom Capital Management. Ernest Partners is your core plus fixed income manager. Remember, again, some of you have been here the whole time, but we went from a core to a core plus mandate. Core plus just incorporate some higher yield holdings into the portfolio. Ernest Partners is a minority owned firm out of Atlanta. We talked about your real estate. Prudential, we have PRISA and their PRISA fund and PRISA 2. The difference is core and core plus. The biggest difference between core and core plus is the amount of leverage in the portfolio, or amount of leverage allowed in the portfolio. And your farmland manager is Ceres Partners. Ceres Partners, and I'm sorry, down here, UBS is a second piece of agriculture. So those are our asset managers. Any questions on any of those? Real quick to the performance of the individual managers, you can see here your large cap value, that being Cornerstone, has done a great job over the last number of years. Last year, they were down 3.1%. I'm sorry. They're down 3.1%. The index was down 8.9%. So again, there's some of that downside capture that we try to avoid. Outperformance of 580 basis points. Looks about the same for 3 and 5 years. 3 years is 6.8 versus 1.8. That's in the 20th percentile of large cap value managers. 5 years, 7.9 versus 4.6 in the 18th percentile. That's your large cap value manager, Cornerstone.
Hey, Greg.
Yes.
For some of the new members, can you just give a little brief definition of how the percentile works? Is low good or is high good?
Absolutely. When we look at percentile rankings, a manager is in the first percentile is the best of the percentile rankings. So you want to have a lower number as far as percentile rankings. You want to be in the top quartile, top half, whatever your criteria is. We look for managers that are consistently in the top half, so top 50%, or the 50th percentile of any universe. Everyone all set on that? You can give me thumbs up and I can go from there. Large cap growth. As I mentioned, a little bit of underperformance. Even though you look at that 16.7% last year for Wells Capital, it is one of the best numbers in the portfolio. It's just that you had to, this is where you had to be. You had to be large cap and you had to be growth. And so that 16%, as you look down through any of these performance, mid cap, Davenport was up 4%. International growth was up 80 basis points. International value was actually down 9.9%. You look down through any asset class, and 16.7% is the best performance of any manager you had. It's just they happen to be in that tough sector of large cap growth. And like I said, you had to have those 5 companies. And not only did you have to have those 5 companies, but you had to have them in the 5 to 10% weighting of the portfolio. Wells Capital is a little bit more diversified than that. You can see that hurt them during the year. Longer term, they're doing fine. If you look at the 3-year number, the 20.2% was in the 29th percentile of a large cap growth universe. They got off to a slow start. Their 5-year number is 14.7 versus 15.9. Slight underperformance, but they are in the top half of that large cap growth universe. Solid job by Davenport in mid cap. They've outperformed their index. They've now been in here 4 years, which is why you don't see a 5-year return here. But they've outperformed their index over last year. They beat it by 6.3%, and over the last 3 years, they're 11.8 versus 5.8, and put them in the top third of their universe ranking. International equity. International equity is made up of two pieces. It's made up of Artisan Partners on the international growth side. It's made up of SSGA on the international value side. Again, we combine growth and value because over time, we hope that these managers can outperform their respective categories. And, you know, long-term, you see some outperformance. Axiom is your international equity manager. They've done a pretty good job on the international or the emerging market side. Last year, they beat their benchmark by 9.3%, 930 basis points for the June quarter, or June fiscal year, 5.9% versus negative 3.4%. So very good job on the emerging market side from Axiom. Fixed income we talked about. Again, this is Earnest Partners. And a lot of those red numbers that you see there are really because of their exposure to corporates and not governments. Real estate, again, there's two pieces of real estate. One is PRISA, one is PRISA 2, one is core real estate, one is core plus. They have last year 3.5% and 2.7%. The Increase Odyssey Index, which stands for the National Council of Real Estate Investment Fiduciaries. Odyssey is open-ended. It's a conglomerate of other open-ended real estate funds. That conglomeration of funds was only up 2.2%. So your manager outperformed their benchmark. Agriculture and this is your farmland series was up 6.3%. Remember, our real asset portfolio is really there to offset what we think will be very minimal returns from your fixed income manager. Think about it logically. Fixed income reacts negatively to rising interest rates. Interest rates are relatively low, and the only place to go is up. So you will get, if interest rates rise, you will get negative return in your bonds. Real estate and agriculture do not care what interest rates do. So we are picking up current income on your real estate portfolio of around 6%. We're picking up current income off of your farmland portfolio of about 5%. Just think about, compare that to a 10-year treasury at a little, so let's say in the 2 to 3% range. So that's the purpose of our real asset portfolio. I started this last year, maybe the year before. I go back and I will make recommendations, and these are ones that I made last year. And I kind of make comments. Did we get it right? Did we get it wrong? And so my first comment, and this is going to be very consistent. I'm not going to take it away as far as recommendations. Maintain a close watch on active managers to ensure positive alpha. That's why you have active managers. That's why you're paying a total of 58 basis points for the management of this portfolio. On a net basis, we have outperformed your benchmark, but maintain a close watch because that's what active managers are supposed to do. 3-year domestic equity, or your domestic equity portfolio has a 3-year alpha of 0.39, led by Cornerstone with a positive alpha of 5.09, Davenport of 6.41, and Atlantic Capital of 10.96. The negative contributors, well, Wells was flat. SSGA, that the enhanced index fund, again, mainly because they haven't overweighted those tech stocks, contributed a negative alpha of 1.64. Total alpha of the portfolio, the entire portfolio, all the pieces together, total alpha is 1.09. Just as a yeoman's definition of alpha, it's a risk-adjusted measure of managers' added value. So that your managers have added on a risk-adjusted basis about 100 basis points of return over their benchmarks. That's a very loose definition of alpha. Last year we talked about foreign relations. Remember, we were talking about tariffs in China and all sorts of stuff. Oh, the world has certainly changed since I was in front of you guys last September. So, as I said, little did we know how markets would move during this last year. We've had COVID. We've had, an election year. I don't have to go through especially for you guys here in Charlottesville. I don't think I have to go through, just what's gone on in this world. Like I said, the short-term decision to keep international investments lower than the target, that was correct. Fed's lowering short-term interest rates was certainly not expected, and that was really because of COVID and the slowdown of the economy. Lowering interest rates, falling interest rates are going to give you a better return, a positive return in bonds, and we certainly did not expect at this time last year that we would have gotten 7.6% in our bond portfolio. I don't expect that going forward. Again, this was to kind of segue into our next discussion. As a fiduciary, and I, you as commission members, you are fiduciaries. Me as your hired gun, your investment, someone who's been hired to counsel you on investments. I am a fiduciary, and I'm going to show you some fiduciary language that is in your investment policy, taken right from the ERISA code. And I know you've talked about it. I did watch your meeting from last month, by the way. So I know you've talked about it. And no, you're not an ERISA plan, but whenever someone questions whether you are fulfilling your fiduciary responsibility, it's the ERISA language that people fall back on, because that's where it's listed. So the DOL puts out, the ERISA language, and we'll kind of go through that. Continue discussion. Keep your fiduciary responsibility in mind. I think I've told you guys over there, I'm your investment consultant. I don't make recommendations on individual holdings. That's what your managers do. So we can direct managers to invest things in certain ways. And I think that's kind of where we're headed. And I just want to show you how much we can get done. My recommendation for the current year, if you look at the very bottom of this page, again, this one doesn't change. Make sure your active managers are producing positive alpha. There will be some impact from the 2020 elections. There's no doubt about it. We need to be cautious of a slowing economy, and just pay attention to who gets elected and where we think the markets will go. We've seen the impact of COVID. COVID's not going away. It's had an impact on real estate already. Just think about, commercial real estate space. Commercial real estate exposure is going to have a negative impact on some of those holdings, and it will be a headwind going forward. There are places that COVID has had a positive impact in real estate, industrial. So just take Amazon, for example. Amazon needs industrial space to house all of their products. So Amazon has been a great example of someone who is spending money on real estate, on real estate, specifically industrial real estate, warehouse space to store all their goods. Again, ESG, it's not something I recommend, but I can certainly help you get there. And there are reasons why I won't recommend it, and I'll go through them. ESG is not any.
Jolie, you didn't just.
Yes.
I apologize.
Okay. And the reason why I don't is it in ERISA language, it says that you have to manage a portfolio in the expressed interest of the plan and its participants. And again, that's right from ERISA language. What I tell you is check with your legal counsel and adhere to state mandated guidelines. So a lot of times the state or someone will hand down edicts to you as a commission saying we want you to divest of all energy companies. And that's an easy process. That's the way it kind of takes that fiduciary standard off of your plate. Examples of that, for example, a lot of states have tobacco restrictions. Those are edicts from the state saying, Massachusetts, I know off the top of my head, Massachusetts, you cannot invest in a company that derives more than 15% of its revenues from the sale of tobacco. So that is a state mandated edict, and that gets put in the portfolio. So that is a type of ESG investing. And so that's kind of what I'm talking about when I say adhere to state mandated guidelines. Any questions on any of that performance information? Again, this is when I first did this, it was a one-page summary. It's now stretched to 3. So, and that boils down that 200-page report that you have in your possession.
Hey, Jason, this is Chris. Real quick, you and I had talked about by email a week or two ago. VRS released their returns for last fiscal year, and I don't recall what they were off the top of my head, but that our plan performed better than VRS. Am I correct in my recollection of that?
Yeah, if I'm remembering correctly, I think VRS's return for the last fiscal year was around 1.4%.
Yeah, it's in that area.
So, I mean, they do have a different risk profile. They made some changes. So, I mean, certainly we want to be careful comparing, but they are the major, player in Virginia in this market. So just for comparison, that's out there.
All right. So any questions, anything I can clear up or talk to you guys about it as far as performance?
Well, I think we should be grateful that we're showing a solid positive return for the year, especially considering the year.
Yeah, and again, that was through June. So I think through August, most plans are up in the 7 to 9% range. So we've had a pretty decent recovery for the first quarter of your fiscal year. So we've gotten off to a good start for 2021.
A lot of uncertainty ahead that is way out of our control.
A lot of uncertainty ahead. Like I said, we've got an election coming up, and we'll have to stay, on a little fleet of foot to make sure that we keep on top of things.
So I guess just one quick question, and then a note. So Greg, you're feeling like the portfolio is appropriately positioned for what's coming, and then just as a time check going into the next topic, we have about half an hour left.
All right. Yes. We always preach about being properly diversified, and that's what we feel you guys are. And we tend to be a little higher quality. Higher quality. Like I said, I talk about downside capture ratio. We perform better in falling markets. Always have, just because of the higher quality nature of the portfolio. All right, so hopefully you guys can, and I just remembered I can make it bigger. This is when we talk about fiduciary standards, and this is in your investment guidelines that were drafted in 2018. It gives you a lot of information, but here's the part of regulatory. This is language directly out of the ERISA code, and this is kind of what I live by. And when we talk about ERISA standards, it says you must discharge his or her duties for the exclusive purpose of providing benefits to the City of Charlottesville Retirement Fund members and their beneficiaries by defraying reasonable expenses and administering the plan. The part that I highlighted there was for the exclusive purpose of providing benefits. And the second reason, why I don't overreact to this is it also tells you what a fiduciary should not do. And it tells you here specifically, act in a manner affecting the retirement system on behalf of any person or organizations whose interests are averse to the interests of the City of Charlottesville Retirement Fund, its members or beneficiaries. So when I tell you to be cautious, that's the language I'm looking at. So just be cautious of, getting involved. I think I turned it political investing. Again, it's not that I agree with it or don't agree with it. It's that ERISA fiduciary language at this current time. The DOL has talked about revising this somewhat, but that's a language directly out of ERISA. So all that being said, and I will have to make this larger, I think, but I don't know how.
There's a plus button on the ribbon above.
Oh, there it is. Thank you very much. Thank you very much. So this is, I focus mainly on the equity portfolio. And these are your investment managers on the equity side of things. So it does not include, because it takes a little more work, a little more time to get all the information on all the properties within PRISA, as well as to get Cirrus to quantify what they have in their agriculture portfolio. It's not something that they actually manage. It's just something that, again, that comes about in their portfolio. So I want to look at all these equity pieces. Oh, it also does include Earnest, which is a relatively easy piece. It's active, and we can certainly make changes to that. So when I talk about your portfolios, I'm going to look at two different things. Number one is, are they active or passive? Active managers are managing to an index, but they don't hold the entire index. Passive management, like these SSGA products, the S&P Midcap 400, the Russell 2000 Growth Index, they are a complete and total replication of the index. So you can't really change something that is, by definition, a complete and total replication of the index. Active managers certainly can, and the active pieces you have here, well, I think we put them in here, but Wells is an active product. SSGA, the large cap, is an enhanced index, so they don't own all 300 stocks. I'm sorry, all 500 stocks. Davenport is an active portfolio. Atlantic Capital is active portfolio. Artisan is active, and Axiom is active. Those are your active portfolios. Those are the ones that you can certainly, number one, if you aren't happy with their ESG investing or their ESG research, you can certainly find a product that is. Or in some cases, like SSGA on the U.S. large cap enhanced, they have an ESG alternative that is it's not a complete and total replication of the S&P 500, but it is an ESG type of investment. So they do have that alternative. So let's go through these, and I talked to you about PRI signatories. PRI stands for the UN Principles of Responsible Investments. PRI is an international organization that works to promote and incorporate environmental, social, and corporate governance factors into the investment decision-making process. Okay, so theoretically, Wells Capital has signed on as a PRI signatory, so they have added a layer of research into their process that includes the incorporation of environmental, social, and corporate governance factors. So they take into account this UN resolution, this UN Principles of Responsible Investment into their process.
So Greg, it's already in their recipe.
It's baked into the cake. Mm-hmm. All right. So I think now, as a result, number one, it's a growth manager. Growth managers do not have a lot of exposure to energy. And we've kind of separated out defense contractors and gun manufacturers. In our research, what we found out is it's not necessarily all defense contractors. You may just want to get rid of gun manufacturers. Gun manufacturers is the more common type of restriction when you look at ESG investments across the board. So that would be your Ruger, your Smith and Wesson, companies like that, versus a Lockheed Martin, or you might be surprised at some of the defense contractors in there. If there's any firefighters on this commission, Oshkosh is the biggest producer of fire trucks in the world. most likely some of the fire trucks you have there in Charlottesville are produced by Oshkosh. They also produce armored vehicles. So Oshkosh is on a list of defense contractors. But when you look down through here, again, Wells Capital, and this is a commingled fund. They do not have an ESG alternative. So they do not have another commingled fund that is ESG compliant. But as you can see with their PRI signatory and the fact that they're a growth manager, they have no exposure to any of those sectors. SSGA, again, it's enhanced index. They are a PRI signatory. So again, part of that incorporation of environmental, social, and corporate governance kind of falls into their process. It's part of the process that they use to enhance that index, to take it from 500 stocks down to 300 stocks. So yes, it's in there. Does it really have an impact on it? Well, 2.4 of the companies in that enhanced index are energy companies, what we have termed energy companies. There's also 1.9% in defense contractors. Those energy companies, by the way, are mostly ExxonMobil, Chevron, and down here it's Lockheed Martin and Northrop Grumman. That's your basic exposure within that portfolio. Cornerstone is your large cap value manager. It is a separate account. It is separately managed. They are not a PRI signatory, but as a separate account, the difference between a commingled fund and separate account is commingled. You're commingled with other institutional investors. A separate account is they manage a portfolio. It's custodied at your bank, and they do it on your behalf. We put together guidelines to tell them what they can and cannot invest in. So the difference between this and say a Wells Capital is it's not a commingled fund. They buy the stocks in your name, and we can tell them to or not to invest in certain securities. So this is certainly one where they're not a PRI signatory. It's a concentrated portfolio. You got 30 stocks in here. They don't have an ESG alternative, but we can tell them to not invest in energy companies. The only thing they have here is in Chevron. That's your exposure. That your biggest exposure is really Chevron in this entire portfolio. Chevron, by the way, and here's where it gets a little blurry. It blurs the line. Chevron is the biggest producer of non-fossil fuels in the world. So they work on other different, and you think about Exxon is another one. They were the headliner for producing energy through algae. I think you've probably seen those commercials during the Super Bowl. So Chevron and Exxon are the two big ones. Cornerstone has Chevron. If you wanted to go this route, all you do is add a line in your guidelines telling Cornerstone not to invest in energy companies. If you want to pick a service, there are services out there that will rate companies based on their carbon footprint. You can do things like that, and they would have to get a version of that that listing and not invest in certain companies. Value managers do not, for the most part, have gun manufacturers or defense contractors. Their big ones are going to be energy and utility companies. Get to some of your passive guys, SSGA. These, again, complete and total replications of the benchmark. Yes, SSGA is a PRI signatory, but it does not come to effect when you're talking about passive management, again, because by definition, they buy the entire product. They do have ESG alternatives in these asset classes, but they are not yet seeded, which means they have not opened the portfolio. There hasn't been enough interest in it. In order to open one of these portfolios, they need about $75 million to open it. And that's kind of their benchmark. I think you've got under $5 million in each one of these products. The S&P 400 has 1.4% exposure to energy companies. It's got defense contractors of about 30 basis points. Again, I can run through those names if you really want me to. On the small cap side of things, small cap, a lot of the smaller energy companies are owned by governments, or they are private companies. So you don't see a lot of energy companies in small cap, especially small cap growth. You'll see a little bit more down here with Atlantic Capital, a little bit less with Atlantic Capital, but gun manufacturers, the gun manufacturer in the Russell 2000 is Ruger. So again, by definition, you're going to have those companies. In order to get out of those investments, there's really not, as I've done some research, there's really not a lot, there's no plan or no funds out there that give you a socially restricted index for mid cap and small cap. Certainly common in a large cap, but not so much in mid cap and small cap. You got the same issue down here with emerging markets. When you look at emerging markets, you look at these energy companies, that's where you have the most of your exposure to energy companies is down there in the emerging markets. A lot of foreign companies deal with energy, oil. A lot of Chinese companies are in the business of making money through finding oil and natural gas. So that's where you get that. And again, in order to avoid that, maybe you take out your emerging market exposure and put it into developed markets. I don't think there's an alternative to that. Davenport on your mid cap side, yes, they are a PRI signatory, so that comes into their process. As you can see here, they believe that stronger ESG policies can contribute to a company's long-term sustainability of growth. So as a result, they do not have any exposure to any of those categories. Atlantic Capital, small cap value. Atlantic Capital, I don't know if you guys are familiar with the company, the Calvert Social Equity Mutual Funds. Atlantic Capital is the manager for the Calvert Social Equity Small Cap and Calvert Large Cap portfolios. So they are very aware of social investing issues. We say here they have an alternative, but the alternative is a separate account as we add that language, but they don't currently have any exposure to any of those categories. Again, international, here's where you're going to find some of your, and especially on the value side, you're going to find oil companies within that portfolio. And yes, they are, again, they're a signatory. We can go back to that language, but they do not currently have an alternative investment, alternative commingled investment that you can invest in. Artisan, again, PRI signatory. They explicitly incorporate ESG into their investment process. They are going to have, again, now you're looking at the growth side of thing where you're going to find, exposure on the growth side internationally is defense contractors. The foreign counterparts of companies like Lockheed and Northrop Grumman. In this case, believe it or not, Airbus, the French airline company, Airbus produces some parts for military aircraft and therefore are thrown into that defense contractors sector. So Airbus is one of the companies you hold within that mutual fund, and it is listed as a defense contractor, a portion of their portfolio. The other one there again is Oshkosh. They do not, Artisan does not have an alternative investment, again, because they incorporate ESG into their investment process. Did I say Axiom? I meant Artisan. Axiom's emerging market manager. Again, they don't have a alternative investment, but again, you saw through the exposure in the emerging markets index fund that you are going to have energy exposure within this portfolio. One of them is a Indian conglomerate, which not only has energy, but it's got retail. It's got they produce magazines, so it's a big Indian conglomerate. But it gets thrown into the energy bucket. They do not have any gun manufacturers, defense contractors. Again, the defense contractors in emerging markets are mainly government-owned or private companies. So you don't see an exposure in emerging markets in those type of companies. The total exposure within all of this that I just went through, and I apologize for talking so long about it, but I think I see this stuff in my sleep now because I've looked at it for a lot of places. The total exposure that you see from this piece of portfolio is less than 3% of your entire investment. Less than 3%. Again, I think it's because a lot of your managers have signed on as PRI signatories, and you don't see the exposure in their portfolios. So without trying, you have actually limited some of your, or you have actually implemented some ESG investing by hiring these managers that have signed on as PRI signatories. We did not expressly ask them if they are PRI signatories. They kind of did this on their own. But we have over the years hired the managers that have, as you look at these, very little exposure to energy or defense contractors or gun manufacturers.
That's great information, Greg.
Again, it's just information. So
yeah.
I think the big thing is
can we get this matrix? Can we get this matrix forwarded on to Justin for distribution to the commission?
I can. I sent it to Jason. Justin, you said?
Jason, can you get it to Jason?
Oh yeah, Jason's got it.
Great.
Sorry. But again, I wanted to show you the exposure to it. I think the next step is you guys have to decide if it is something you want to enact further. Again, without even thinking about it, you've taken steps, and the exposure in your portfolio on the equity side, you're going to have some exposure in your bond portfolio. But on the equity side, it's less than 3%. There are things you can do about it, like the biggest piece, your cornerstone exposure to Chevron. You can tell them not to invest in Chevron because it is a separately managed account, and when we have that capability. You can switch from this SSGA large cap enhanced portfolio to the SSGA U.S. Community Investing Index, which still has a slight bit of energy exposure. I think it's 1.2% of the portfolio, so it cuts it in half. But they do have that portfolio, and as most ESG type of investments nowadays, the returns over the last 5 years have been better than the product you have, mainly because you're taking money out of energy and you're putting in the technology. And that's an easy switch. Anyone who has any overweighted technology is going to have better performance than someone who has energy stocks. So every ESG product over the last 5 years has outperformed non-ESG products just for that factor. But they do have that alternative. So you can take little bites from that apple. That's an easy one. Cornerstone's an easy one. The passive pieces are a bit more complicated because again, there's no ESG managed mid-cap 400 index or Russell 2000 growth index out there.
Greg, could you also produce like the past 5 years of the SSGA and Cornerstone funds that you were describing that could make an easy switch, and see, so we can see what their performance was, maybe in a graph chart?
SSGA I can. Cornerstone I cannot, because that's all you're doing is taking out one stock, and
right. Right.
So you've got to
Gotcha. I get you.
I could maybe have Cornerstone go back and produce a number, a back tested number that doesn't have Chevron in it, but it's not a real number.
Yeah.
Whereas there are two funds. You have the SSGA U.S. Large Cap Enhanced Fund, and you've got the U.S. Community Investing Index Fund. I can certainly show you comparisons. Just I can tell you the U.S. Community Investing Fund last year was up 11.6. SSGA was up in the 6% range. 3-year was 12.9 versus 10.7, and 5-year is 12.4 versus 10.7.
Okay. Yeah. If you could produce that in hard copy form, that'd be great.
Yeah. And I brought that up just because, you know, in watching the meeting from last month, someone brought up the Blackstone ESG, and, you know, like I said, large cap, there are a lot of alternatives. This was just an alternative that SSGA had as your passive manager, and the returns are actually better than that BlackRock ETF. And the third thing is the U.S. Community Index Fund is 15 basis points, and the management fee for BlackRock is 25. So you get the same manager you have, it's 15 basis points versus 25, and the returns are better. So there are a lot of those funds out there.
Okay, great.
I think if you want to, again, look, this is the toughest area down here just because there are 67 names in the emerging markets index that are energy names. I think the only way you can eliminate those is to eliminate emerging markets as an asset class. I think that's your alternative is you've got to eliminate an asset class, and that's when you get into that language when you say is it a positive thing to have exposure to emerging markets? Is it in the best interest of the plan and its participants? That's where I'm going to say, well, I think you're missing out a little bit on emerging markets if you're not in there. So that's the tough one, is down there. The other ones are a relatively easy fix, or the exposure to some of the companies is minimal. But yes, I can produce that for the difference between the U.S. Community Investing Index versus your current U.S. Large Cap Enhanced Index.
Thank you. And as to the emerging markets, you know, damage doesn't only occur to those businesses when you divest. Damage also occurs in a lot of cases to the society as well. So from an ESG perspective, divesting from emerging markets may create negative social impacts that we don't want to incur for those areas of the world.
Hey, Greg. We've been talking this morning about and a lot of our conversation over the last few months has been on our existing portfolio. I guess what I'm interested in, would also be interested to hear from my fellow commissioners is, as we go forward, as when we look for either new asset classes to invest in or considering replacing current managers, are there criteria that we can build into that search process that incorporate some element of ESG along with all the other things that we look at as well: fees, returns, risk, et cetera?
Absolutely. Absolutely.
And so I mean, we're kind of running out of time this morning, but is that something that that maybe you already have in the can, so to speak, or something that you could send us as we look at both the existing portfolio, but then also think about it going forward?
Absolutely. That, like I said, it was never a mandate before. It was never something that we really paid attention to. I think, as you can see, it is an issue with managers in a lot of places. All of your managers, with the exception of Cornerstone, are signed on as a PRI signatory. So, again, without doing it, we've actually done it. And if you look at and we never asked the question, we probably could have. Like with Artisan, they explicitly incorporate ESG into their process. So again, without doing it, we've done it, but we can certainly ask more. Again, these are not. We called managers to ask them their opinion on ESG investing, how they incorporate it, and this is a summary of those phone calls. So if we would have asked the question during an interview process, those are the answers we would have gotten.
And I guess, that's, somewhat my point, but also just so that we're more deliberate about it going forward. And then from a fiduciary standpoint, I do worry about, some of the impacts that we're seeing in the world on long-term financial performance of either companies or asset classes or something like that. So I think it's both a deliberate exercise, but again, also one as we think about, returns over the next 15, 20, 30 years, just something, again, to factor into our decision making.
Yeah. If there's no impact on performance, this is a moot point. You just, take it and you take out those companies and it's not going to affect you anywhere. The issues we've had, Chris, is a lot of the time period that people are looking at, the last 5 or 10 years, you've had oil drop from $130 a barrel down to 30. And that's going to affect energy companies. On the flip side, you've had companies like Google and internationally Alibaba and other ones that have just exploded at some point in time. And you've kind of seen a little bit of it over the last couple of months. That dynamic has to change. It always has over time, and it always will. If you look back in the 70s, energy was 30% of the S&P 500. Energy right now is about 2% of the S&P 500. So it's a much less of an issue now than it was before. But at some point in time, energy is going to be more than 2% of the S&P, basically with oil prices. So, and again, that's what I caution people about is putting a dead stop on certain type of investments, and then longer term, when you have those perform better, and you have a manager come in and say, well, we would have performed better, but we couldn't hold this company. That's a direct impact of the decisions you're making. And again, I'm not an attorney and I'm simplifying this a little bit, but let's just take a scenario that you miss your long-term return assumption because you haven't invested in certain companies. And because of that, you've got to decrease benefits. You're going to have maybe a beneficiary or a participant come in and say, well, you're lowering my benefits because you didn't do your job. And so, that's, again, I've simplified the whole thing just to give you an example. And that's what I want to make sure you guys pay attention to. If there's no difference in return, then certainly go ahead and do it. But I would leave that up to the managers. Again, if they're all signed on as PRI signatories, let them make that decision for you. The ones you can't, like I said, I love Axiom. They've gotten you some great returns. They've beaten their benchmark by 1,000 basis points. But if that's something you think you need to get out of the portfolio, then we can certainly, take that out of the portfolio. I think you're missing out on returns if you're not in emerging markets. So.
Yeah, thanks, Greg. I think we need to be careful on how swiftly we move. And I think we've been very fortuitous in looking at this information here to see and find that we're less than 3% invested in non-ESG investments. And the numbers that you see on this matrix are very encouraging. And I'm wondering, and I'm going to put you on a point a little bit, Heather, how council would respond and whether or not this is information that's appropriate at this time to push to council as an update as to where we are with ESG.
Yeah, I think it's important to let council know what progress has been made and the steps that have been taken. I mean, I can certainly work with Jason myself to provide that update. At the same time, we have to remember this is this group's decision in terms of the direction that we go, and it's important just for council to understand why any decision making that we make as a body, why we come to that decision making. But it was before this even current council that this was first raised and then sent to the retirement commission as a kind of an action item from council to explore this. So I think, we'd have to also just kind of update this current council on kind of just the history of why we got to this point and what are recommendations that come from this body.
All right.
But I think this maybe kind of gives you a summary of just exactly what exposure you have. I'm not sure if you knew what kind of exposure was in there. And again, I can give Jason a list of all the companies. Let's see if I can do that on here.
Yeah, that's certainly something that we can send out.
Yeah.
And we'll make sure all these documents go out as well. So everyone on the commission will have this document as well as Greg's financial summary. So we're just about out of time for this meeting. The only other note that I wanted to make was we do have a meeting scheduled next month. And if you remember at the August meeting, we discussed a little bit about potentially rescheduling the November and December meetings since they normally would have fallen in the holiday weeks so that we can continue working on this. I think if everyone's agreeable to that, we can try to find an alternative date for the November and December meeting, if that sounds okay.
Please do.
Okay, great. All right. That's the only other item. Brian, are there any public comments or members of the public that have joined the meeting that would like to say anything?
We don't have any attendees that I can see. So anyone who wants
Okay.
to speak would be in this panelist view and could chime in now.
Correct. No attendees at this time.
Okay, great. All right. I think that's it then. Do we have a motion to adjourn the meeting?
So moved.
Heather, second?
Second.
Chris? All right, all in favor?
All right.
All right. All right,
Thank you
thanks,
all.
Greg.
Thank you
Thanks,
all.
everyone. Thanks, Greg.
Thank
Appreciate
you.
it.